everyone. A very good evening. You're watching The Money Show on ET Now with me, Mubina Kapasi. This is the show where we help you get your finances sorted. And today I have a very interesting and very special guest with me. This is of course to help you sort out your topics with respect to money management, and I think it's pretty crucial that you get that done because we are living in times of uncertainty, and more so I suppose for all of you who are invested in the equity market via mutual funds, via directly in stocks. You may be a bit perplexed as to how you should go about essentially managing your finances. And if you're not invested, then I'm sure the question is that is now the right time, when the markets have fallen quite a bit, is now the right time then to invest in the equity markets? I have with me then a very interesting guest, CA Dr. Aman Chugh, who is an advisor with reputed corporates and industry associations in India as well as abroad. In fact, he is also often called as the father of financial planning, portfolio management and derivatives, and he is here to help you out with all the questions and queries that you may be having with respect to your portfolio and with respect to money management. Dr. Chugh, thank you so much for joining us today on ET Now. I'm sure the last few weeks you as well may have got a lot of calls from your clients, etc., that, oh, my portfolio has fallen, or, oh, I'm in the negative and, my capital has been erased, etc. In such a situation, Dr. Chugh, how should one essentially manage their money? What sort of tips would you like to give them, their personal finances?
So first of all, let me say Namaskar and Jai Hind. It is always a pleasure to be coming on your show. It is one of the wonderful shows I have ever seen. So first of all, we need to be clear on fronts like this is the time we need to rebuild our portfolios, because many times we do not understand our portfolios as the portfolios which include the real estates, the equities, the gold, the FDs, the PPFs and the mutual funds. For a layman, actually the portfolio is ideally, one believes that portfolio means a portfolio of equities or mutual funds. That's it. No, it's only a smaller portion of an overall larger portfolio which we have normally developed. And normally, portfolio building or rebuilding measures should not happen through brokers. It should happen through advisors, which surprisingly in India is quite low in numbers. And hence, in the name of financial planning or portfolio management, many companies or many advisors or brokers, they tend to do a sort of goal setting and tend to sell their own products, which is ideally a mutual fund guy will be selling a mutual fund, an insurance person will be selling an insurance, or a real estate guy will be selling in real estate. So first of all, we need to understand that we need to have a balanced size of a portfolio, and we need to rebalance that portfolio as of now. So maybe speaking on stocks as of now, not all stocks will give you return always. Not all mutual funds will give you return always. Not all real estate will give you return always. Say, for example, stocks like Maruti or HDFC Bank were giving quite a good returns. But for the last 2 years, Maruti has fallen from 10,000 of a level to almost a 5,000 of a level. Even for the last 3 years, we have seen that maybe the pharma companies are not performing well. Now the pharma stocks are on a bull run. Similarly, on mutual funds, we had at one point in time HDFC Top 200, which is renamed as HDFC 100 now in 2009s and 10s. Then we have suddenly a Most 35 coming up. Then we have Mirai as well. But these all mutual funds also re-change. So hence, the idea is even the real estate. Earlier, we used to be more customized to the real estate residential flats. But now residential flats or maybe commercial offices space in malls. But because of the coronavirus issue and the work from home issue, I think we need to redesign the real estate portfolios as well. So point is, time has come that we need to sit down and redesign our whole of portfolios, and not only equities or mutual funds. So maybe in equities, we need to shred off maybe the small caps and the mid caps, because they are very, very volatile. And since it is a coronavirus, it is not a financial crisis, wherein in a financial crisis, you can pump up the money and then you can get the money through. But because of the corona crisis, the financial crisis and the economic crisis has come by, and we have not seen the bottom as yet. So hence, I think we need to maybe look at only the larger returns or a larger mutual funds or maybe a larger caps of a portfolio. And many times we only look at larger returns which has been given by one stock, and we remain happy. Oh, my portfolio has given me a wonderful return. But what about the total portfolio which we have built? So hence, I think The point is, a lot many amongst us, we look at, oh, I have made good amount of money in Reliance Industries or good amount of money in HUL or maybe a Nestle, but we forget the blockage of money in real estates or even a lot many mutual funds or even the bond funds or even lot many mid caps and small caps which have crashed by almost 50-60%.
That's actually a very good point. I mean, a lot of us tend to look at our portfolio in buckets. You have to look at your portfolio very holistically. You have to consider every financial investment made, not just, of course, in shares and, be happy because RIL has done well and you have RIL shares or any other asset class. You have to look at what real estate is doing. If you have any, financial investment in real estate, in mutual funds, so on and so forth. I think that's Dr. Chugh's message. It's a very important one. So, Dr. Chugh, at this point of time, let's say if, some of our viewers have cash in hand and they're looking at the market and they're saying, oh, look, the markets are low. Why don't I start off by investing? Maybe I can buy a mutual fund, an ETF, or maybe I can sort of buy individual stocks. Or maybe for that matter, maybe invest in a little bit of real estate. How would you recommend they start their investment journey then right now?
Sure. So first of all, we need to understand that we cannot predict the bottoms and the peaks. But obvious, the bottoms in this type of a crisis which has been triggered by coronavirus, and coronavirus triggered financial and economic crisis would only be bottomed out, I must say, when the vaccination site is visible, first of all. And even when the vaccination site is visible, it will definitely lead to a upturn in the markets, but not to all stocks. Because you can understand that while with the lower rate of interest and with the kind of slowdown and maybe the recessions in the Western world, it could maybe also lead to a lot many businesses fallout, which are dependent upon these type of industries. And hence, as I mentioned, we need to redesign and rebuild our portfolio. So first of all, if we have got cash in hand as of now to invest, we should be first of all sure from where are we getting this cash. So that means if we are running a business, first of all, you need to check whether our business will be able to generate the cash in the next few years or few months down the line, or whether if we are employed, are we employed in such type of an industry or such type of a company wherein my employment is fine and my salary cut will not happen or I'll not be thrown out. Once this is satisfied, then maybe we need to divide our existing cash amount which we have to invest into two angles. One, till this vaccination issue does not get solved out, maybe we need to build up a cash related corpus only, maybe parking my savings account or an FD in fundamentally strong banks, in fundamentally robust banks. And we should not be going with the smaller banks in this type of times and experiment with higher returns and take leverage on those banks, or maybe some cooperative banks, etc. And if at all, then we have some money left out, then we need to also divide the corpus into different segments. So that segment can be maybe, I would also recommend taking a direct exposure in fundamentally very, very large stocks. So maybe directly entering into the stocks. Maybe it will give you better dividends. You'll get the full bonuses as well. You will lower down the commissions, the trail commissions with the broker stake, etc. Second, maybe you can take exposure in different good mutual funds. When I say good, I of course mean that you need to churn those mutual funds regularly as well. Similarly, very fundamentally sound bond funds as well, because the kind of credit spreads which has been happening because of the bond liquidity challenges, even RBI is pumping money, giving money across to the banks to be funding it further to the NBFCs or the micro financial institutions or even the smaller mutual funds as well. But yet the money is not flowing through down the drain. And hence it is leading to a challenges with so many corporates bonds. And mind it, when we say that the bonds in India is AA or A plus, well, these all AA or A plus in the international market is idly junk, because India's credit rating is BBB minus. So BBB minus, India's credit rating in the world, is just one notch above the junk bond. So any bond which is a AA plus in India or a A plus in India, it is definitely a lower down the rating as against the government bond, and hence we are taking exposure in a maybe a junk bond in the international terminologies. Also, this is what I am talking about, the cash which you need to invest now. Maybe you need to divide it, and you need to divide and diversify it scientifically. Not that let me put some 20% into equities and 30% into bonds and 20% into somewhere like this. No, this is how a normal financial planner or an advisor or a broker does it. No, it has to be very, very scientific. Also, just to give an example, in this kind of a scenario, when we know that the interest rates are low, dollar index is at, let us say, almost at 100 level, which is the DXY, and with US printing of more money, I'm sure the gold will become a new asset class wherein it will see a rally. So maybe more exposure can be taken into a gold side of a asset class, or maybe more exposure can be taken into a pharma or a FMCG of a stock and maybe come out of a conventional infra stocks or maybe some sort of automobile stocks as of now. So hence, this is on your existing cash which is lying. But mind it, the existing portfolio as well, you need to check it through, because it should not happen that while you're concentrating on your additional cash, where do you invest? But how about your old investments parked into small caps and mid caps who are gone bust? Or maybe even bonds which are not doing good, or maybe a leverage bonds, or maybe a NBFC exposed bonds, or maybe real estate which is not doing good. So I think we need to take care of these all things as well. So I mean to say genuinely diversified.
How should one then how should somebody who is facing negative returns in their mutual funds, in their stock portfolio, then deal with that? Because sometimes the temptation is to just leave everything then because you're so scared, right? What would you recommend such viewers do?
Okay. So again, I come back to the basics. Is it the only mutual fund which is giving a negative return? Is it not the stocks? Is it not the real estate? Is it not the debt funds as well? So I think again, sit down, look at the portfolio in different asset classes, within each asset classes, further assets as well, within real estate as asset class, maybe how many residential plots or residential flat do you have? Are they generating return? It should not happen that you are just paying EMIs and you're not getting the returns as well, or maybe the appreciation as well. Similarly on stocks as well, similarly on mutual funds as well. So while your question is that how do we cope about with the negative returns of a portfolio, first be sure that your portfolio is such that you can sleep well. If your portfolio is such that you cannot sleep well, you are overexposed on maybe a leveraged NBFC bonds, then maybe even if it is a negative return, come out of it, book it through. Because unless and until you are waiting for God will come one fine day and you will say, boss, this money will be again flourishing back. No, we have already seen in the past what happened with ILFS and a Divan Housing and a Yes Bank as well. So that means we need to be very quick on reacting. Just to give an example, while because of the ILFS crisis, it was all evident that there was a crisis in NBFC industry, or maybe the bond markets, which is not a AAA plus. We should have already come out of it. Why were we waiting for something? Or even if the corona crisis was evident in January and February, are we still waiting for some sort of stocks to rebound? So that means we need to maybe come out of these negative yielding mutual funds if their corpus is not that great. When I say great, but of course with education, with understanding, maybe on your show, you should look at it maybe to guide people as to what is fundamentally right investment, because most of the times we take exposures particularly based on the herd mentality. This is very important. And also, in fact, many times we have seen that we look at the negative returns and we say, should I average? No, don't average in such a manner that it is negative by 20%. Let me put my more money into it. And then it goes again, fall further down. And then you put 20% more. And then when it falls further down, what happens? You actually end up booking the whole lot of losses. So you need to check the portfolio where you can book the losses and come out and rebuild your portfolio. Maybe that can be a tagline for today. Rebuild the portfolio in Corona days.
All right, use these days to rebuild your portfolio, and it will be a good time for you as well to study in on your portfolio, especially since you're at home, you're quarantining, so might as well use this time to do just that. Okay, let's take on board some questions and queries then, and folks, if you have any queries, you can you can email us today on themoneyshow@etnow.tv and we will take up your query. First up, let me take some existing queries that we've received via email. We have Mr. Dheeraj Purohit who writes into us saying, I'm 28 years old, interested in building long-term wealth using equity portfolio. Goal is to have 30 lakhs by the age of 40. Investing 6,000 per month in mutual funds through SIPs. He can increase the amount to 10,000 rupees. Now he's got a couple of funds: DSP Equal Nifty 50 Fund, DSP Nifty Next 50 Index Fund, the Kotak Standard Multi Cap Fund, L&T Mid Cap Fund, L&T Emerging Business Fund. He wants to know if this portfolio is okay. Dr. Chugh, what would you recommend, Dheeraj? Any chops and changes?
The point is, first of all, we need to clarify, Dheeraj ji, that while he said that he wants to build up a portfolio in such a manner that he gets a 30 lakh rupees of a corpus, that means he's again betting on future. What if after 12 years, when he's 40 down the line, and there is another sort of crisis, a similar crisis which we are witnessing today? So maybe one would have planned in 2008 that by 2020, I would look for maybe a 30 lakh rupees of a corpus. And suddenly coronavirus has come by. So that means we should not define our long-term goal setting as a financial planning. Hence, this is very important for us to understand, because we normally tend to build our portfolios 12 years or 15 years down the line by saying that by 15 years down the line, I need 40 lakh rupees of a corpus. However, you need to look at as to what type of stocks, mutual fund, asset classes are you taking by. Also, you must look at the economic cycles, because economic cycles changes the portfolios. Say, for example, there was a crisis way back in 2008 because of the subprime, and hence there was a different type of crisis. In this type of crisis, we have got a crisis which has emerged from China. So hence, any stocks or any mutual fund which has got an exposure, particularly on Chinese stocks or a Chinese related underlyings, that would not be doing good. So hence, as he mentioned that he has been investing in some few mutual funds for the last 3 years, he needs to look at whether he needs to churn those mutual funds as well. Since the question is particularly related to those mutual funds, let me check those mutual funds maybe in terms of technically, maybe I should be able to answer this, because it should not be. So one by one, looking at his first mutual fund exposure is Kotak Standard Multi-Cap Growth. So well, it has got a standard deviation which is risk of 20%, and its alpha is negative. That means the excess return as against the market in this mutual fund is not that great. However, the stocks underlying is doing good. It has got Reliance Industries, ICICI Bank, HDFC Bank, Ultratech, Larsen Toubro. These all stocks are good. So maybe he can keep his money into this type of a mutual fund. DSP Nifty is a good underlying because it has got exposure into Avenue Supermarts, HDFC Life Insurance, Dabur, Divi's Lab. These are all good stocks doing good. And maybe even the DSP Equal Nifty, I can see the portfolio. It has got stocks like Hindustan Unilever, ITC, Dr. Reddy's, ONGC, Cipla. Well, apart from ONGC, I think rest of the stock seems to be good as well. L&T Emerging Fund Direct Growth, I think emerging fund as of today, because of the volatile growth story and volatile challenges and changes, I think he should come out of this mutual fund, particularly because it is not exposed to the blue chips. And also its standard deviation, which is the risk, is around above 20%. Similarly, on L&T Mid Cap Fund as well, it has got a standard deviation, which is risk of around 22.89. And plus the stocks, apart from Abbott and IPCA, I don't see fundamentally strong shares. So hence, I think he should be coming out from these two mutual funds as well. Apart from that, maybe I would suggest him, he should also think of taking exposure in different alternative investment class, which can be maybe REITs are coming, real estate investment trusts are coming, or maybe government bonds are hitting into the market directly, and maybe he should subscribe to those government bonds as well, RBI bonds as well. They are risk-free, at least if we talk on Indian context. Maybe he should take or increase his exposure into gold, because of the happenings which has recently happened, and the going forward scenario looks like lower interest rates, excess of liquidity, risk averse mode. So people will be more inclined towards gold. So maybe he can park some of his money into gold as well.
All right. So that's, of course, the recommendation then coming in from Dr. Chugh. Dheeraj, I hope you've taken note of that. Okay, Mohit Gupta writes into us saying, I've invested 20 crores in the Franklin Ultra Short-Term Fund since 3 years. They have shut the scheme. Can you let me know by when all investors should get their total money? Do we have to forego the interest completely? What can be the worst situation? Dr. Chugh, the entire thing is really a very scary scenario. What would you recommend he do?
So first of all, it is very important again to understand that without education, without knowledge, I think you should not be taking an exposure into building up your portfolio. And with that stuff, maybe in 2018 when there was ILFS crisis, he should have come out of from all such mutual funds which are exposed on NBFCs or particularly distribution companies on power. Because see, Franklin Templeton, these all 6 schemes, or particularly the 2 schemes which he's speaking about, they had 23,000 crore rupees of an exposure, particularly on NBFCs. And NBFCs exposure was around 14,500 crore. On power distribution companies, it was 5,500 crore. And on, let us say, real estate infra developers, it was 3,500 crore rupees. This means that 23,500 crore rupees out of this Franklin Templeton of a corpus of 6 schemes was not into fundamentally sound investments. And hence, I really feel pity that he did not come out earlier. But going by this trend, maybe he should understand that these all types of mutual funds, particularly on ultra bond or maybe short duration, these were all leveraged into lower rated bonds. And there is a difference between the duration of the bond and the Macaulay duration. So I think he must be exposed on those bonds, keeping into view that he would be able to come out of those bonds easily. But I don't foresee him to be making money out of it. Maybe on interest part, he's already foregone. I'm talking about the principal. He needs to wait at least for maybe another 1 to 2 years, only if the assets being sold off by these mutual fund schemes are able to generate money. And after that money is being generated, they will have to pay the banks, because these schemes were actually leverage schemes. That means they had taken some loans from the banks as well to fund the prepayments by the investors. So hence, maybe he should have also looked into this matter as well, because if these type of schemes or the mutual funds who take exposure into taking loans from the banks to make the prepayments, that means we need to abruptly come out of these schemes at an early stage. So it will take maybe for another 1 to 2 years, only if the crisis comes back to normal and these all investments which has been made by these 2 mutual funds are able to generate money. And after this money is being generated, the money is being paid back to the lenders, and then only the proportionate equated rights will be distributed among the unit holders.
Okay, so that's of course, what happened in Franklin. For now, of course, for Franklin unit holders who do have these debt funds, they have no option but to wait as and when Franklin gets the money from, the entities that it has lent to. It will keep distributing it to unit holders. So just pay attention to emails, communication from Franklin with respect to the same. All right, we have time for just one more query. Karthik writes into us saying, I haven't started investing anywhere till now, but currently exploring options. I'm 24 years old, working in UAE, and can invest 50,000 rupees per month. So Dr. Chugh, he's young. I suppose he can take some risk as well because he's just 24. He lives in the UAE. Dr. Chugh, I think you've already given us some great advice on how especially young investors and first-time investors can start off. But, just to answer Karthik's question, anything specific you have for Karthik?
Yes, sure. First of all, maybe in continuation to the earlier one, there are myths in our world at present that bond investments are safe. No, this is a myth. Bond investments are not safe. Depends what type of bonds are you exposed on. So if it is a government security or RBI bond, okay, it is safe as long as government is doing good, or maybe we do not get into a junk bond of a notion. A second myth is that when the interest rates start falling, we need to be investing in bonds. No, interest rates start falling does not mean that the bonds value will go up. The bonds value goes up only if yields, they come down. So if interest rates are coming down, that means it is not necessary that yields also fall, because yield is a function of other factors like credit rating and credit default spreads as well. So this is a myth which I wanted to add maybe. Speaking about the specific query from our gentleman who is from UAE, first of all, he needs to check back whether his job is secured in the times to come, because as of now, because of the oil crisis, maybe the certain companies into Gulf countries or UAE will also take a hit, and maybe some employees can be terminated, or maybe the salary cut down can happen. So maybe he need to check that whether his job is safe. Second, he needs to also build up a liquid money into his portfolio, because of this corona crisis, we do not know the bottom, and hence he would not be sure about his job as well, or even the crisis which is happening in UAE of a market because of the oil crisis as well. So maybe he should look at parking some of the funds into liquid money as well. Well, exposure can be built into different types of assets. Why only invest start investing or taking risk into mutual funds, as I mentioned, maybe he should look at some sort of large cap stocks, fundamentally very strong stocks, and maybe large cap mutual funds as well. He can also try a mix of gold and try churning them. He should not be holding these all large cap stocks or large cap mutual funds for long term, because the age changes. So as of now, let us say the trend is for pharma companies or a FMCG. Maybe he can ride on that trend, because as we say, the trend is the friend. Also, while he said that he can take risk, a lot many people, they believe that higher the risk, higher shall be my return. No, the clarification is higher the risk, higher is my expected return, but the actual return can be negative as well. So we need to maybe take this into our stride with a pinch of salt as well.
Dr. Chugh, I must say you've come with your own fresh set of opinions, which I suppose will give all of our viewers a very different perspective as well as to their return expectations. The usual norms that do surround personal finance as well are something I think that you have very nicely busted in some cases, and of course confirmed as well. But Dr. Chugh, it was really a pleasure having you with us today on the Money Show. Thank you so much for your valuable opinions and of course answering the questions and queries we've been getting from our viewers. I must say we're still getting a couple of them, but I don't think we'll be able to, I don't think we have the time to be able to take them. Yeah, I don't think we're going to be able to take them. So we're out of time. Thank you so much, Dr. Chugh, once again for joining in. Folks, if we've not been able to take your query, don't worry. We will be on from 5 p.m. every day on the Money Show, where we will get your questions answered. Well, yesterday we also spoke to Mr. Ved Jain to talk and guide all of you viewers on which tax regime you should choose, because FM Sitharaman in budget introduced a new tax regime and gave all individuals an option if they would like to opt for the new tax regime. And you need to inform your employer, if in case you're salaried, you need to inform your employer right now which tax regime you're choosing, because the TDS will be deducted accordingly. So here's a guide on how you can choose your tax regime.